Every smart investor has a secret weapon. It's not luck. It's not a crystal ball. It's economic data. Welcome to the EDPF Property Academy, where we turn insight into action. Today, you'll learn how to read South Africa's economy like a map and use it to make sharper, more profitable property decisions. The market isn't just a game of chance. It's systems. And like any system, once you understand how it works, you can navigate it with confidence. Think of economic indicators like the dashboard of a car. They tell you if market's overheating, slowing, or cruising. Imagine driving a car with no dashboard, no speedometer, no fuel gauge. You wouldn't feel safe. Investing without understanding economic signals is exactly like that. As an investor, indicators help you anticipate shifts and avoid blind spots. There are three key types. Leading indicators predict what's ahead. Coincident indicators confirm current conditions. Lagging indicators explain what's already happened. Each plays a role in shaping your property strategy. Leading indicators include building permits and bond approvals. They show you what's coming. Coincident indicators include employment rates and retail sales. They show what's happening now. Lagging indicators like GDP help us reflect on recent performance. Knowing the difference empowers you to make proactive decisions, not reactive ones. Interest rates, controlled by the Reserve Bank, shape your affordability. When rates drop, buying surges. When they rise, budgets shrink. Think back to 2020 when COVID hit and the Reserve Bank cut the repo rate aggressively. Suddenly, monthly repayments on bonds dropped and a wave of first-time buyers entered the market. Properties that were once out of reach became affordable overnight. But when rates climb, that affordability vanishes. Timing is what matters. A single percentage point increase on your bond interest rate can add hundreds or even thousands of rands to your monthly repayment. That impacts not only homeowners, but investors with multiple properties. Pro tip: lock in fixed rates during low cycles to protect your cash flow. Fixed rate financing is your safety net against sudden economic shifts. Inflation measures rising prices. It affects everything from your construction costs to tenant affordability. When inflation is high, every rand buys less. Groceries go up, petrol goes up, and tenants have less disposable income. Developers feel the squeeze as building materials and labor costs rise. But real estate has a hidden advantage. It's a natural inflation hedge. Why? Because rental income often rises with inflation, especially if you structure your leases with annual CPI-linked escalations. That way, as prices rise, so does your income, helping you stay profitable even in volatile times. Think of it as building an automatic increase into your contracts. It's not just smart, it's essential. GDP tells the story of economic health. When GDP grows, demand grows for homes, offices, and retail spaces. It signals more jobs, more disposable income, and more tenants with the ability to pay. After the 2021 economic rebound, we saw a surge in logistics, warehouses, and neighborhood shopping centers. GDP growth fuels confidence. Investors start building. Tenants start spending. But a shrinking GDP is a red flag. It signals job losses, spending cuts, and rising vacancy risk. Smart investors align their strategy with GDP cycles, expanding during growth phases and consolidating during contractions. South Africa's unemployment rate is one of the highest globally, and it directly affects your bottom line. High unemployment means fewer people qualify for rentals, more vacancies, more defaults, and more tenant turnover. That's risk. But risk can be managed. If you're in residential rentals, you should consider tenant categories with stable income like NSFAS-funded students, healthcare workers, and government employees. These groups offer predictable cash flow. In uncertain economies, tenant quality is everything. You're not just renting property, you're managing risk. New construction signals optimism, but too much of it leads to saturation. Watch local council approvals. If dozens of new complexes are approved in your suburb, ask yourself, is the demand there? Oversupply leads to falling rents and higher vacancies. That's why data-driven location scouting is vital. Always compare building trends with population growth, infrastructure, development, and job creation. Development without demand is a recipe for disaster. The rand's value affects far more than just your travel plans. For developers, a weak rand makes imported materials like tiles, fixtures, and fittings more expensive. If your project depends on imports, your costs can balloon unexpectedly. A weak rand can also deter foreign investment, reducing liquidity in premium markets. The smart move? Lock in prices early, negotiate bulk deals, and monitor the rand closely if your cost base isn't 100% local. Consumer confidence is the X factor in property cycles. When people feel hopeful, they invest, rent, and upgrade. When confidence dips, they postpone big decisions. No one wants to buy property when job security is uncertain. Use consumer confidence information to time your sales, flips, and developments. Launching luxury apartments in low-confidence market? Risky. But launching affordable units in a cautious market? That's smart positioning. Credit is the fuel of the property engine. When banks are lending freely, the market booms. When they tighten, everything slows. Monitor bank lending rates, bond approval ratios, and affordability thresholds. If you're a developer, understand how your buyers access credit. Design around affordability. If you're an investor, know your credit score cold. And if lending dries up, pivot to rent-to-own or JV models. Staying ahead of the curve means using the right tools. Set up Google Alerts for key terms like repo rate or Stats SA GDP. Subscribe to reports from the SARB, BER, TPN, and Lightstone. Use dashboards that bring all your data into one view. Being informed isn't optional. It's the foundation of a profitable, resilient portfolio. Don't rely on opinions, rely on numbers. Let's get tactical. Interest rates down? Fix your loans and expand. Inflation up? Activate CPI clauses. GDP booming? Chase capital growth. GDP declining? Prioritize stable income and cash flow. The best investors don't guess. They adapt. They use economic data to switch gears, rebalance portfolios, and structure deals strategically. Let's look at real examples. In 2022, rate hikes froze development pipelines. But short-term rentals boomed, especially near tourist zones. In Braamfontein, NSFAS-linked leases outperformed generic student housing due to payment reliability. This is why micro-market analysis matters. National averages are misleading. Zoom in. Understand your street, your node, your suburb. That's where your edge lives. Sustainability means predictability. Your portfolio should be balanced across asset types, provinces, and tenant categories. Don't put all your equity in one location or one segment. Spread it smartly. Cash flow is king. Passive income isn't just a dream. It's a result of disciplined structuring and market insight. Build your model like a business, with measurable KPIs and clear growth plans. Risk isn't the enemy. Unmanaged risk is. Protect yourself with emergency funds. Screen tenants thoroughly. Use insurance products to shield against vacancies and rent loss. And never over-leverage. Diversify your risk like a portfolio manager, not a gambler. Know your downside. Prepare for it. And build systems that hold steady when markets wobble. Reading economic indicators isn't optional. It's essential. It's your competitive edge. The more you understand the economy, the more control you gain over your financial future. If you're ready to build a data-driven, resilient portfolio, join us at EDPF Academy. We're here to help you invest smarter and build wealth with purpose.